Hope everyone's doing well and had a good day. In this video, I'll do a brief recap of the Emini 5-minute chart for Wednesday, July 9th, 2025. The first thing I want to talk about is the daily chart. We have a bull trend, tight bull channel, but possibly leg 3. 1, 2, 3, but very tight channel here. Now the market is far above the moving average. Then we have a 3-bar micro channel, not particularly strong, but we do have 3 consecutive bars with highs that are trending lower. Now if you're a bull and you bought a high close, you're disappointed when the market goes against you, bear breakout, and follow through. Inside bar, it's a triangle. Most traders probably will not sell above the inside bar, but they will sell above the last bear bar, which is the bar before it. So that's why I have the high of 2 days ago marked in blue, probably sellers in this area. This is a bad high 1. Again, we're in a late leg in a trend, far above the moving average. We have a high 1, but the pullback was deep enough to disappoint traders who bought higher. That's going to lead to resistance and sellers above. So the expectation today, probably sellers above Monday's high and probably a trading range day. And then before we get into the 5-minute, I do want to talk about the Globex chart. Look at the 15-minute chart. What we'll see is we have a bull channel going into today. Different ways to draw channel lines. Maybe it's here, maybe it's here, but either way, we have a bull channel, and on the open, we're breaking out above the bull channel. Let's actually look at the 5-minute chart, because I do want to talk about this. Whenever you have a bull channel and the market's breaking above the channel line, the odds favor that the breakout will fail and reverse within about 5 bars and then test the trend line. We can simply draw a parallel for the trend line, and really it doesn't matter if we use the 15-minute chart, the 5-minute chart. It's really whichever highest time frame the pattern is visible on. So you can see tight bull channel on the 15-minute and breakout above the expectation, reversal within 5 bars. So buy climax on the open, but when Al says 50% of breakouts on the open fail and reverse regardless of strength, what he's talking about is the Globex chart context. Some breakouts, some bull breakouts after a gap up on the open are great candidates for low of the day, and they're good to be traded. But other times, like here, this is a low probability event. Bull channel, bull breakout, 75% chance reversal down, and you take into consideration the higher time frame context. Let's just see. Let's go back to the .D, regular trading hours only, and you'll see the blue line on this chart correlates to Monday's high. So the blue line on the daily chart and the blue line on the 5-minute are the same price. And we can see where the market rallied to on the open today. Gap up, far above yesterday, but yesterday was a small, tight trading range, inside day. It's interesting to see inside bars are triangles, and you can see them more clearly on smaller time frames, and you can see it here. We have more highs and higher lows. And whenever there's a pattern happening on the higher time frame, they usually repeat on the lower time frames. So that's something to look for on the 5-minute today as well. Gap up, follow through buying, 4-bar micro channel on the open. Good for the bulls, second leg up likely, but we have to keep in mind that about half the time, this will be a buy climax testing resistance, and the market may fall to below bar 1. Why below bar 1? Because bar 1 remains the low of the day about 20% of the time. So just closing your eyes and throwing darts at a board, you're going to be right 80% of the time in saying that bar 1 is not the high or the low of the day on most days. Also, the trader's equation. We have to think in terms of equidistant moves. 1 to 1, the bulls have a stop below bar 1, they buy the close 4. Pretty good momentum, but we're far above the average price, and 1 times the actual risk is all the way up here. So the bulls start losing momentum, and when the bulls lose momentum, they lose their edge. They have bad risk reward, and their probability is getting worse. When the market's far above the moving average, traders want to buy a pullback rather than momentum, especially when there's evidence of the momentum waning. Reversal and follow through 5 and 6, bad high 1. This is kind of like the daily chart, probably sellers above bar 6 for a second leg down, which happened quickly on bar 7. We quickly went outside down, so you can call it 2 legs down to bar 6, pull back, and down on 7. But this is fairly tight, and this might all be 1 leg down. Maybe there's a pullback and a second leg down to bar 11. But at this point, the market's in a tight trading range. Some traders might view it as a triangle. It doesn't really matter what you call it. What's important is that you recognize the market is in breakout mode. So the market's in breakout mode, far above the moving average, with all of the context I said, probably sellers at the blue line or near around the blue line on the daily chart, which is shown on the 5-minute. But also it's a bull breakout of a bull channel line on the Globex chart. And bar 1 probably will not remain the low of the day. So breakout mode, we get the breakout 12, probably will lead to some sort of measured move down. And at a minimum, the bears want to get to the low of bar 1, which they do on 13. Breakout follow through, maybe there's a measured move based on height of the breakout and follow through. Looks like we already reached that measuring gap. Maybe there's a measuring gap like this or this. And then when the bull breakout fails, you can also look for a measured move down based on the height of the bull breakout. So magnets down here, we're also close to yesterday's close and this breakout point, the bar 77 high. So magnets below to look for. Bears are in control, it's always in short. Big up, big down, probably a trading range day, not a bear trend day. So even though we have this big bear breakout, which is probably the dominant feature of the day, it's still not likely a bear trend day when you start with a 4-bar bull breakout like this. More likely a trading range day. Second leg down and some sort of measured move down after 12 and 13 is likely at this moment. 14 reversal bar, but weak, probably sellers above. There might be buyers below 14, but probably sellers above 14. The first reversal should be minor. Micro channel since bar 9, sellers above the high of the last strong bear bar. We can see it bounce below 14, but this is still a minor reversal. There's no trend line break. And then finally down to 18, we have a buy reversal bar testing near support. You can call it a spike in tight channel from 14 to 18. 3 pushes, 1, 2, pause, 3. The problem with selling above 18, it's a buy reversal bar. Traders will probably instead sell above bar 17, the last strong bear bar. Because 18 closed above its midpoint, it's a buy reversal bar. You could argue the bulls controlled the bar. Probably sellers above 17, second leg down, likely at least for a scalp. 19, a stronger bull bar than bears want to see. Still probably minor, still probably sells above 17, but 19 might be discouraging for some of the bears, which may lead to buyers below 19 and at the new low 18. This is a low one, but again, it's big up if you include the gap, big up, big down, probably a trading range, and we may be low in a developing range. If this is a spike and tight channel and channels evolve into trading ranges, it's more likely we get the bull breakout of this bear channel and test somewhere near the low of bar 1, the high of bar 14, the start of the bear channel. But first reversal probably will fail and be minor. Reversing back down, we can see a bounce on 20. Looks like sell the close. Bears on 18, disappointed with 19. But ultimately, the bears got their new low, but there are buyers at a new low. Double bottom, 18, 22. Low probability buy. Small risk, big reward, which means you must have low probability. But we're testing breakout point, and again, it might be low in a developing trading range. Might be 3 legs down, 1, 2, 3. Second reversal above 22. Bears might cover, exit shorts above 22, and aggressive bulls might buy for a scalp. But there's still no significant trendline break, so any reversal here is probably going to be minor. Really good bar for the bulls. Little overlap closing on its high. Context decent. It's at least a double bottom at support. 22, 23, reversal and follow through. It'll probably get a second leg. And then 24, this is an I1R reversal bar that goes for 1R. If you bought above 22, stop below 22, market went at least 1 times your initial risk. So stop order bulls making money. Do stop order bulls make money in strong bear trends? No. This is either developing into a broad bear channel or a trading range. Because of that, bulls might have a major stop or a major low at 22, but it's not clear because we don't have a clear higher high on 24. So stop location below 22, maybe not ideal, because if the market goes below 22, the odds are there are buyers down here rather than sellers. But to buy 24, the bulls have the problem of big risk, low probability. The trader's equation is bad. The bears are still probably going to get some sort of second leg down. And if you're buying here, you're buying a second leg up, 1, deep pullback, 2, right below the moving average, high in this possible trading range from 14. And while this 3-bar micro channel should get a second leg up, buying the close 24 is not ideal. Again, if it's a trading range, breakout points close. So because 22 was an I1R, there's an area of interest for limit order buyers. Now at this point, limit ordered bulls, where stop order bulls made money. That's the high of bar 22. 25, a warning for the bulls, 3-bar micro channel below the EMA, waning momentum. So if you're buying here, you're buying momentum because you're at resistance. And then you get 25, that's usually a warning for bulls to bail out and look to buy lower. Again, because the trader's equation is bad, the stop is far, and the context, location for buying, not ideal. You're buying at resistance, and the bears still might need a second leg down. This could be a low too short. 26 tested that breakout point, the gap, the 22 high, and reversed up. The bulls got their pullback and minimum second leg for a scalp, probably sellers above 24 if we get there. Breakout to a new high above 24, but now we have 3 pushes up, and some traders will see this as a wedge double top, bear flag, 3 pushes, 1, 2, 3, double top with 24 or 16, any of these highs, close to a double top with 16, slightly lower high, double top with 14, doesn't matter. Different computers see it different ways. But either way, there's a reasonable sell here on 28. Signal bar isn't great. It's a small reversal bar. You can wait for higher probability and wait for the breakout. Other traders will take the stop order sell below 28. But I think if you're long for any reason, it's reasonable to exit below 28 because the bulls have 3 legs up against a strong bear breakout. The market appears to be in a trading range. We might be in the upper third. So this is the area where it's good to sell and take profits if you're long. Strong bear breakout 29. Very little overlap, similar to 23. Little overlap with the prior bar. Reversal and follow through context is good, but forcing you to sell in the middle of the range if you sell the close 29. So there might be traders selling in the sell zone of 29, or maybe a 50% pullback of the reversal and follow through. But second leg down likely because this bear breakout should get a better second leg than just this. And the reversal and follow through 28-29 should get a second leg, and the wedge 3 pushes up should correct for a couple of legs sideways to down. So reasons to sell here after 29. 30 pulling back, testing the sell zone of 29. Probably sellers above 30, second leg down to at least below 30 likely. And then 31 another bull trend bar, but overlapping the prior bar. It's 2 legs up, 1 pull back. 2, testing resistance. Now we have a head and shoulders, left shoulder, head, right shoulder, probably sellers at the breakout point of bar 28 and above the breakout bar 29. So still second leg down, likely for the bears. Now the bulls have 2 pushes here in what might be a 4th leg. 1, 2, 3, and 4. So 20 or 31 might be a sell the close bar for a scalp. The target, probably the low of 30, or more conservative, the close of 29. Inside bar, 1 bar triangle, breakout mode. This is a tight trading range. Might be better to step aside and wait for the breakout when the market enters such a tight trading range. Second leg down, still likely for the bears, but after that it's becoming confusing, at least for me. 33 bears get their second leg, but now we have a completed structure for the bears on the smaller scale. The bulls might need a better second leg after this 3-bar rally. This might be a nested high 2 on 33, high 1, and then a double bottom high 2, and again nested, so high 1, high 2. But 33 a bad stop order buy, forcing you to buy at the top of the trading range, and the bears still might need to get to a new low of the day or test somewhere near the lows. After such a strong breakout here, this still looks like a minor reversal. I'm going to speed it up here. Very tight trading range, and this is the fractal triangle pattern I was talking about earlier. We see the triangle on the daily chart, and we're seeing it on the 5-minute as well. So we're getting a contracting range where the highs get lower and the lows get higher, and the market gets squeezed. And this is an area of agreement. The market is in balance. Bulls and bears are taking trades and scalping both ways until one side gets squeezed and gives up, and there's a breakout that you can trade. 39 through 41, 3-bar micro channel, breaking out above the bear trend line of this triangle. The problem with buying here on 41, if you do buy here, you might use a wide stop, because with a breakout of a triangle, the market often comes back and tests the apex of the triangle, the midpoint, which is all the way down here, this purple line, which is near the low of bar 39. To have a stop below 39, if you bought, might be a skunk stop. It's kind of like if you had a stop above bar 29 if you sold. It's not a great example, but whereas like I was saying over here, putting a stop below 22 earlier, when it's not clearly a major higher low, not ideal, but here the market's creating higher lows and higher lows, so this might be a reasonable stop location at this point. on the 3-bar micro channel. If you buy, maybe you use a wide stop. And with triangles, there's a 50% chance the first breakout reverses and fails and reverses and goes the other way. So bull breakout, but the bars are about average in size. Breakout's not going very far. We could easily reverse back down into this trading range. And then outside bar reversal, follow through for the bears. Trying to break out below the other direction, the bull trend line. If we compare strength 39 to 41 versus 42 and 43, the bulls control more bars, 3 bars to 2, uniformity, uniform size bars, bars closing above their midpoints, above the high of the prior bar, whereas here it's just 2 bars, 42 being an outside bar, trading range behavior in its nature, expanding triangle, and then 43 big tail below indicating buying pressure. Why weren't the bears able to close bar 43 near its low, which tells me there was not a sense of urgency to sell into the close of the bar. Probably sellers above 43. It's a bad stop order buy. But as far as big up, big down, probably buyers low and sellers high. And both sides might need a second leg here. The bulls need a second leg up, the bears need a second leg down. The market's fairly neutral. The more bars that get added to this trading range from bar 14 to basically 43, 44, it's about 30 bars. Once you pass 20 bars, breakout direction becomes close to 50-50. So the odds of trend resumption for the bears, bear trend, trading range, and then bear breakout really gets reduced to about 50-50. This might be a final bear flag. 44, bull breakout, disappointing entry bar if you sold above 43. So bears may just look to exit at break even if they sold above 43 after seeing 44, but tight trading range, not the ideal environment for trading. It might be better to fade breakouts rather than trading breakouts and second legs in such a tight trading range. It's a limit order market. Bulls getting their second leg up, 1, pullback 2 with 2 pushes, testing resistance. The bears looking for a second leg down, but we're still creating higher lows and higher highs. The bulls will argue at this point there's an upward slope. The market's in a bull channel, which is a bull trend, higher highs, higher lows. And it's more likely that we break out to a new high before we break out below a low. And where's the stop order sell for the bears? Maybe below 48, low 2, nested, 1, pullback 2, low 1, low 2. Bears still looking for a second leg down. This bull channel could all be a bear flag. So there's a reason to sell below 48, but forcing you to sell with a stop order in the middle of a tight trading range, not ideal. And again, I'm going to speed it up here. Tight trading range continues. Limit order market. Traders are fading breakouts, betting that breakouts will fail, buying below bars, selling above bars, until one side loses and gets trapped. So we had an upside breakout here, 55, 56, breakout and follow through. We called it a 3-bar micro channel, breaking out far above the tight trading range, probably support down in the range. Breakout point 54 high. This was not supposed to work. Traders selling above bars all through here and scaling in made money, but if you sold above 54, you're in a losing position. That's going to create support at the 54 high, 53 low, buy zone of this bull leg. Bad high 1, 58, sellers above. This might be a wedge on a smaller time frame, 57 through 59, 3 pushes down, testing near support. buyers below 59. This is also an inside bar, 57, so a triangle which grew. Range is contracting. We had a bull breakout, range expansion, then range contraction. Probably will get range expansion in the direction of the original breakout. So bull breakout, pull back, second leg up. Likely, this looks like a minor bear reversal, which is the trading range, which is a bull flag. 63 might be a double bottom, bull flag, breakout to a new high, but channel phase, trading range day, probably limited upside, sellers here. Bear breakout, but 5 bar, bull micro channel, testing breakout points. Probably will bounce here for the bulls, and there will be a second leg up, but this breakout might be strong enough from the bears for a second leg down. The bulls buy support, they get another leg up, but now we have 3 legs up to resistance on from earlier in the day. Breakout point, bar 8 low. We're approaching this breakout point created by bar 12. Probably resistance here. High 1, but trading leg 3 for leg 4 at resistance, more of a sell zone. But the channel is fairly tight. And the bulls actually do have open gaps. So there's an open gap here from this close, bar 47 close, to over here, no close overlapping. And then the 64 close to over here, no close overlapping. So it's very subtle, but there is sign of strength by the bulls here. It's really hard to want to sell, but also very late in the day, not worth trading past bar 75 or so. And then here, expecting more sideways trading range as we test a breakout point on an overall trading range day. Big up, big down. Ultimately, the bear breakout reversed and failed to get a symmetrical second leg. It got a small second leg here, but ultimately we reversed and tested the breakout point. That's going to be it for today's Emini review. Thanks everybody for watching and listening, and I hope everyone has a great night.